Welcome to Money Obsessed YouTube channel. Why are the smartest entrepreneurs driving stunning cars while you are stuck paying more tax than them? Let me tell you something. It is not some secret club. It is not magic. It is simple math, you donut. You can learn this math. You can use these rules. And you can stop throwing your hard-earned money down the drain. This guide is your wake-up call. I am going to show you exactly how it is done, step by bloody step. I will use simple words, not that accountant rubbish that puts you to sleep. This is for small business owners. This is for entrepreneurs who want to win. Listen up, pay attention, and for goodness sake, take some notes. Right, let's get one thing straight. Leasing is not just renting. For a business, it is a strategic financial tool. When your business leases a car, it is a simple agreement. You pay a fixed monthly fee to use the asset for a set period, like 2, 3, 4 years. At the end of that contract, you do not own the car. You just hand the keys back, or, in some cases, you might have the option to buy it. But that is a different conversation. The key here is that the business is paying, not you personally. This is mission critical. You must separate your personal finances from your business finances. If you do not get that, just stop reading now and go back to peeling potatoes. When you buy a car personally, you use money that has already been taxed. Income tax, national insurance, and all sorts of other deductions ripped out of it before it even hits your bank account. Then you take what is left, your net pay, and spend it on a car. It is the most expensive way to do it. It is financial suicide. Infographic, personal buying, tax icon before money to car. Business leasing, money to car before tax icon. When the business leases the car, it uses its gross revenue. It is pre-tax money. The expense of the lease is taken off the business's profit before the taxman even gets a sniff. It is a completely different world. Furthermore, leasing keeps your cash where it belongs, in the business. Cash flow is the lifeblood of any company. It is more important than profit. You can be profitable on paper and still go bust because you have no cash. When you buy a car outright, you tie up a massive chunk of capital, tens of thousands of pounds, euros, dollars, in a depreciating asset. That is money that could be spent on marketing, on hiring a great salesperson, on new equipment, or on developing a new product. It is money that could be making you more money. Leasing, on the other hand, just requires a predictable, smaller monthly payment. It keeps your war chest full. So the choice is simple. Do you want to be the person who drains their personal post-tax bank account to buy a metal box that loses value every single day? Or do you want to be the savvy business owner who uses pre-tax business revenue to access the exact same car while keeping their cash free to grow their empire? It is a no-brainer. One path leads to a constant struggle, always feeling squeezed for cash. The other path leads to financial strength, flexibility, and control. If you cannot see the difference, then frankly, there is no hope for you. Wake up and smell the bloody coffee. Now for the next part. Listen carefully, because this is where you really start to claw your money back from the taxman. I am talking about VAT, Value Added Tax. In some places, it is called PDV. It does not matter what it is called. It is a sales tax added to the price of goods, services, cars, lease agreements. When you, as a regular person, buy something, that VAT is gone forever. It is just part of the price you pay. But when your VAT-registered business makes a purchase for business purposes, you can often claim that VAT back. It is like getting an instant discount paid for by the government. It is brilliant. Let's break it down. Flowchart. Business pays lease invoice with VAT. Flowchart. Business files VAT return. Flowchart. VAT amount refunded or credited. When you lease a luxury car through your business, the monthly lease payment will have VAT added to it. Lease example, $800 a month. VAT rate, 20%. Billed total, $960. A normal person just pays the $960 and cries. Your VAT-registered business pays the $960. On its next VAT return, it claims back $160. Net cost to business that month, $800. You get it? The tax is not a cost. It is just a temporary cash flow item. You are getting a huge chunk of the payment handed right back to you every quarter. Of course, there are rules. Do not be an idiot. You cannot claim everything without checking. The rules depend on your country and the specific use of the car. If getting the VAT back was the starter, then tax deductions are the main course. This is where the real, substantial savings happen. This is how you legally and ethically slash your corporation tax bill. Every single lease payment you make for that car is a business expense. What is a business expense? It is a cost you incur in the process of trying to make a profit. And the beautiful thing about business expenses is that you deduct them from your revenue before you calculate your profit. A lower profit means a lower tax bill. It is that simple. It is not rocket science. It is basic business arithmetic. Imagine your business has a revenue of $200,000, and your other costs are $100,000. Salaries, rent, materials. Your taxable profit is $100,000. If the corporation tax rate is, say, 25%, you owe the tax man $25,000. Now let's add the car lease. Let's say the lease costs $10,000 a year, net of any VAT you reclaimed. That $10,000 is now an additional business expense. So your total costs are $110,000. Your new taxable profit is $90,000. At a 25% tax rate, you now owe $22,500. You just saved $2,500 in tax simply by running the car through the business. And it does not stop with the lease payment. Absolutely not. The fuel you put in it for business trips? Deductible. The insurance policy you have to take out? Deductible. The cost of maintenance? Deductible. New tires? Deductible. Servicing? Deductible. Each one of these costs chips away at your taxable profit, and each one saves you real money on your final tax bill. Amateurs see a price tag and pay. Professionals calculate net cost after tax breaks. Let's talk about a word that scares most people: depreciation. When you buy a car, it starts losing value the second you drive it off the forecourt. It is a stone-cold fact. A $60,000 car might be worth $40,000 a year later. That $20,000 drop is depreciation. For a normal consumer, this is just a painful loss. It is money vanishing into thin air. But for a business owner, depreciation is not a disaster. It is a powerful accounting tool. The tax authorities know that assets wear out or lose value over time. So they allow you to treat this loss of value as a business expense spread out over several years. This is called a depreciation allowance. Capital allowance. Each year, you can deduce a certain percentage of the car's value from your profits. So even though you are not spending any new cash, you are creating a paper expense that reduces your real tax bill. It is like getting a tax break for something that was going to happen anyway. For example, if the business buys a car for $60,000 and the depreciation allowance is 20% per year, you could potentially deduct $12,000 from your profit in the first year. That $12,000 deduction could save you thousands in corporation tax. The next year, you calculate 20% of the remaining value, and so on. The car is still sitting on your driveway, you are still using it, but on your accounts, it is generating a tax saving for you year after year. This makes the true cost far lower than the sticker price. It turns a financial negative into a tax positive. Now, if you are leasing, you might think this does not apply to you. Wrong. You benefit from it indirectly. The leasing company owns the car. They are the ones who claim the depreciation allowances. But because they get this massive tax benefit, it reduces their ownership costs. They factor this saving into the price they charge you. The monthly lease payments are lower precisely because the leasing company is an expert at maximizing these tax advantages. Right now, there are two ways to think about buying a car. There is the consumer mindset, and there is the business owner mindset. One is risk-averse. The other is growth-focused. The consumer mindset sees a shiny car and thinks, "I want that." They go to the bank, get a high-interest personal loan, or worse, slap it on their credit card. They are obsessed with the monthly payment, but they never calculate the total cost. They pay for it with their personal after-tax money, making it one of the most expensive purchases after a house. It is a status symbol, often bought with debt. Understandable, but costly over time. This consumer mindset is a trap. You work hard, you pay your taxes, and then you give the rest of your money to a bank in interest payments. For an asset that is losing value faster than a melting ice cream cone in July. This is the mindset of an employee, a passenger in their own financial life. Now, look at the business owner mindset, the winner's mindset. A business owner sees the same shiny car and asks, "How can this asset make me money? Or how can it save me money?" They think about business finance. They think about leasing. How can I use this to serve my clients? How can it project a professional image for my brand? They focus on cash flow, on tax efficiency, on the net cost after all the deductions. They use the system to their advantage. The fundamental rule of the wealthy: use your own cash to buy assets that go up in value, and use other people's money or business funds to pay for assets that go down in value. A luxury car is a depreciating asset. Let's make this so simple even you can understand it. We are going to put some numbers on this, so it is not just talk. Let's take a car with a sticker price of $60,000. pounds, euros, dollars, it does not matter. The principle is the same. Now let's look at two people. Personal buyer Paul and business owner Susan. Paul wants this 60,000 car. He earns a salary. Let's say his income tax rate is 30%. To get 60,000 in his hand after tax, he needs to earn roughly 85,700 before tax. He pays the full 60,000, including any non-reclaimable sales tax. He then has to pay for fuel, insurance, and maintenance from his after-tax pocket money. Every single cost associated with that car comes from money that has already had a huge chunk taken by the tax man. Now let's look at Smart Susan. She wants the exact same 60,000 car, but she leases it through her VAT-registered business. Her business pays a monthly lease fee. Let's say it totals 12,000 a year, which includes VAT. First, her business reclaims a portion of that VAT. Let's say 50% of it. Second, the entire net lease payment becomes a tax-deductible expense. At a 25% corporation tax rate, that $12,000 expense saves her company $3,000 in tax. All her fuel, insurance, and maintenance for business use are also deductible, saving even more. The difference is staggering. Susan uses pre-tax business revenue, gets VAT back, and lowers her company's tax bill. Her business keeps its cash for growth, and the real net cost is dramatically lower. Right, the rules of the game can change. Politicians love to tinker with tax laws, but the fundamental strategy remains the same. For 2026, you need a clear game plan. You need to be methodical. Do not just walk into a showroom and fall in love with the first shiny thing you see. That is for amateurs. You are a professional. First, choose the right type of car. In 2026, the big incentives are all pointing towards electric and low-emission hybrid vehicles. Electric, hybrid, not petrol. Governments are practically throwing money at people to get them into these cars. They often come with lower tax charges for any private use benefit. They often come with higher rates of depreciation allowance if you buy them. They sometimes even come with direct government grants. A petrol-guzzling monster might look cool, but it could cost you a fortune in extra taxes compared to a sleek electric equivalent. Do your research. Look at the CO2 figures. The lower, the better. This is not about saving the planet, it is about saving your money. Second, get your paperwork in order from day one. This is not optional. You must keep a detailed mileage log. There are apps for this that make it incredibly simple. Track every journey, note business or private. If you claim 90% of your car's costs as a business expense, you need to be able to prove that 90% of its mileage was for business. Without a log, your claim is worthless. Keep every single receipt and invoice, lease payments, fuel, insurance, repairs, car washes. No receipt, no deduction, simple. Finally, do not go it alone. The world of vehicle tax is a minefield. Caps on expensive cars, specific rules about VAT recovery, benefit in kind if you have significant private use. You need a professional. You need a good accountant who understands this stuff inside and out. They will save you far more money than they will ever cost you. Your job is to find the car, gather the quotes, then present the options to them. Let them do the complex math. So, there you have it. It is not magic. It is not a secret handshake. Driving a fantastic car while building your business and reducing your tax bill is simply about using your brain. It is about shifting your mindset from a passive consumer to a proactive business owner. It is about understanding the tools the system gives you: leasing, VAT recovery, tax deductions, depreciation. It is about playing the game by the rules. The smart rules, not the sucker's rules. You have seen how it works. You have seen the difference between the smart way and the stupid way. The choice is yours. Stop making excuses. Stop thinking it is too complicated. Stop giving your money away unnecessarily. You work too damn hard to be that careless. The difference between success and failure in business often comes down to these small, smart decisions made consistently over time. Managing your tax efficiency is not a once-a-year conversation. It is a constant process of optimization. Getting your business vehicle strategy right is one of the biggest and easiest wins you can get. It improves your cash flow, reduces your tax burden, allows you to present a professional image. But reading this is not enough. Information without action is useless. It is like a recipe without a chef. It does nothing. You need to act. So here is your final instruction, your one clear next step. Do not put this off until tomorrow. Do it now. Pick up the phone, write an email, make an appointment with your accountant. Tell them you are reviewing your vehicle strategy for 2026. Ask them to model the numbers for leasing a specific tax-efficient car that suits your business needs. That is your mission. A simple 30-minute meeting with your accountant could save you tens of thousands over the next few years. It is the highest leverage action you can take this week. Consult your accountant for advice specific to your country and situation, and subscribe for more business wealth secrets. Play the game by the smart rules. Thanks for watching. Subscribe for more money content.